Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, guys. Welcome to Bazaar Morning Call. It's Friday morning and you're joining us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia. Today with me is Surbi and Nigel. Folks, it's Friday, but we have a lot on our hands, really, as we begin the day. Reaction to a lot of earnings, global cues to track, but it's still Friday.
Well,
and that is the most important cue, Sonia.
It is.
And good to have you back, Sonia. I think the experience in Gujarat would have been something special, I think.
It was really good, and great to meet so many dignitaries from across the corporate world and interact with them. I mean, the big takeaway actually for me is that India is standing tall amidst the global peers, and a lot of investments coming through. So it was really fun.
It's no longer +1; it's the only one.
The only one. You coined that. I'll always remember that one. Yeah. But let's kickstart with the day's cues, right? I think the most important cue that we'll work with this morning is the reaction to Infosys and TCS's numbers. And we had spoken about this a couple of days ago as well, as to how the street is looking at some positives in Infy's earnings. This time around, the good part is that there is no negative surprise. There are some, worry points, some cautious points, etc. But the key takeaway is, first, the Infosys ADR is up almost about 3% odd. I guess the street was going in with expectations that there wouldn't be any negative surprise this time, and that has come through, so that's a relief. Also, the constant currency revenue growth, it has declined about 1%, but the estimate was 1.5% to 2% decline. So in that context, perhaps you could see a little bit of up move in Infosys this morning. At least that's what the indications are. TCS, on the other hand, I mean, good set of numbers coming through. Revenues, margins, beat street estimates. The margins, in fact, are up for the second straight quarter. So I think the entire sentiment in the IT space will be upbeat this morning, and that's the big cue. The other thing I'm watching is what happens with Polycab. I mean, a very interesting, turn of events over the last many days. There's a clarification that has come in from the management. They said they haven't received any communication from the IT department. But this is a little bit of loss of trust that we've seen in the Polycab stock over the last many days. Will the street take this clarification positively? Could there be a lot more volatility? Time will tell. But for now, that'll be an interesting stock to focus on. The Nifty has been consolidating around that, 21,600 mark. US markets have been largely flat, but this morning, the Asian markets are doing very well. So most of them actually are up about 1.5%. So I reckon that, this consolidation phase that the market has been in the last many days could perhaps be broken on the upside, courtesy the IT names. But then let's see how the rest of the day pans out. A lot of big numbers coming through. There's HDFC Bank that comes out next week as well. It'll post its Q3 earnings on the 16th of Jan. That's next week, I think Wednesday. So all eyes will be on that and the banking space as well. But IT this morning.
IT and global markets. So I'm calling it sort of a lukewarm setup this morning, because we had that US CPI print. It's neither hot nor cold. Yeah. It's lukewarm. So let's just run through the numbers and then we'll talk about more of the internal cues as well. The print, this is December US CPI. This was the biggest watch point for the markets all through the week. So the numbers are out, slightly higher than estimates. The number has come in at 0.3%. If you're looking at it month on month, expectation was a rise of 0.2%. If you compare year on year, so we've got 3.4% versus estimates of around 3.2%. So then why did the market recover? The US market, by the way, was pulled back very smartly from the intraday lows on all the three indices. Not just that, look at what happened to the bond yield. The bond yields have actually declined 6-7 basis points. On this print, it's not like the US 10-year topped 4% or moved higher. And that is because core CPI, that actually was in line with the estimates at about 0.3% month on month. So we don't have much of a big reaction on either the US dollar or the US 10-year. They're range bound, very close to the recent levels. DXY is consolidating around 102.2, 0.3. So not much changing there. And as I said, the US 10-year yield actually cooled off, a couple of basis points. It remains below the 4% handle, and stocks also rallied and recovered. So that is the US inflation, picture out of the way, lukewarm. Now, on IT, again, I'll call it slightly lukewarm because this absolutely takes Sonia's point. It's better than, the market's worst fears. We were working with an Infosys, top line decline of almost 2%. Well, at least it wasn't as bad as that. And even TCS posted a 1% growth versus absolutely flat expectations. But, if you go beyond the immediate comparisons, then the body language is still non-committal. The commentary that came through yesterday still repeated a lot of what we heard in the second quarter. So if the market was looking for a big definitive statement saying, okay, the worst is over, demand is coming back, none of those statements came in, neither from TCS nor from Infosys. So while, yes, we'll probably get a bounce, a relief bounce that the numbers weren't a howler, the question is, do these numbers give enough of an ammunition for these big IT titans and the rest of the IT pack to keep taking the market higher? On that, I have my doubts, and we'll have more clarity. We'll, of course, hear from the TCS management in just a bit as well. Oil is another very important cue, by the way, because of the Houthi attacks that were, launched just a couple of hours back in the Red Sea. Both the US and the UK have launched missile attacks, and there's a risk premium again. So Brent, now it's below 79, but it was 79 plus just a few hours back. Last but not the least, let's talk about this range. So the Nifty has been about in a 300-point band. 21,450 on the downside, 21,750 on the upside. My sense is that we could be testing the upper end of the range. The key watch point is Reliance. Move away from IT, move away from what the Bank Nifty is doing or not doing. But RIL, can it show more of that momentum? That's going to be critical for the market. And as Sonia said, last but not the least, even I'll look out for, Polycab. More than Polycab, the question on my mind is, can the market now start differentiating from Polycab versus the other? So will we see some relief buying come in on some of the other stocks like RR Cable and the likes? But I think we've got a pretty interesting setup for the last trading day of the week, Nigel.
Well, that's right. But crude spiking up to around $80 per barrel. That's a bit of a spoil sport. But in the past, the markets have really ignored that because they believe that normalcy will resume. And we've seen in the past as well that demand really is offsetting any kind of the supply, weaker demand is offsetting any kind of the supply cut. So crude is one factor. That's a bit of a negative. But otherwise, there are quite a few positive triggers. First up, let's pull up the Infosys stock. Yesterday, not at 320, not at 325, but around 328, 329, you had a big spike up in Infosys. Just take a look in the final minute of trade. So normally you'll say maybe there was some buying ahead of the numbers, etc. This is bang 2 minutes before the close. So someone has definitely sniffed that these numbers are going to be very, very good or better at least than what the street was working with. And that's one factor. But yet, IT will support today. And just to give you a few numbers in terms of how much TCS and Infosys, well, they contribute on the Nifty itself. Close to around 10% comes in from both of them. IT stocks on the whole, all 6 of them, they contribute close to around 14%. So that part of the market will be holding up one end. Reliance Industries, second session running, it comes in late of the day and it plays an absolute blinder. Yesterday as well, 2.5% higher, previous session 2% higher. There seems to be some good amount of buying on Reliance Industries, and that's close to around 10% weight on the index. So you have 14 plus around 10, 25% of the index, 24, 25% of the index could continue to support. The Nifty Bank, that's the one that holds the key. It's been coming off on a day-to-day basis from the high point of the day, and it's facing resistance at higher levels. This week itself, we've seen every time it goes around that 47,700, 47,800, we see some bit of selling that comes in, and that's the way it's panned out all through the week. Goes higher, does see some kind of selling pressure. So the Nifty Bank is currently in the middle of that range. The recent low was around 47. The 20 DMA as well comes in at around 47,837. So it's in the middle of that range. You'll have to see which way is it going to break, because that's bulk of the Nifty. So that's going to be the one that gives it direction. Let's pull up what the FIs did. Not too much. They continue to remain net long. 63% of their positions are on the long side. I was looking at the options data, and you have your two pillars of the market. The 21,700 call, that was fairly active. 21,500 put was fairly active, which brings us to the levels itself. Just going by the options data, going by the trading action, I think the Nifty continues to remain in that range. 21,450, 21,850. Maybe the banking names give us further direction. For the time being, IT supports, but we'll need some kind of a booster shot because Reliance Industries is playing its role. IT could play its role, but the Nifty Bank, that needs to break out in either direction. And that's what's going to give us, at the next skew. So for starters, we open up in the green, but we'll need to build onto those gains. And keep in mind, Infosys ended at the high point of the day yesterday. So part of that positive surprise is already in the price.
Okay, by the way, guys, the Mumbai Trans-Harbour link opens today.
Yes.
And, that is an idea that was conceptualized 6 decades ago. And finally, it's seen the light of day. And, we all go through the Mumbai traffic, right? So I know it's a broad sense of relief that all Mumbaikars are getting.
And this is, more than any other project for Mumbai, this is seminal because the whole idea was to change the axis of the city from north-south to east-west. You've got land on the, on the Navi Mumbai side to connect the island city with the mainland city, reduce some of the issues that we have in terms of just log jams, lack of infrastructure. This is massive. It's a beautiful piece of infrastructure. Like they say, I'm going to go back and borrow a line from Devian yesterday. Derai, but durust hai.
Yeah, I know. I think it cuts down traffic time from Sivri to the end of the place to about 20 minutes, right? That's really, really quick. All right. Well, our director telling us to move on, so we'll do that. But today we're going to talk a lot about TCS in a bit as we head to the management meeting. But on the equities side, first up, we have a cue coming in from Rhythm Desai of Morgan Stanley, who says going into 2024, India remains a top pick in the emerging market space. He says the fundamentals are underscored by strong macro stability as a result of improving terms of trade, flexible inflation targeting and stable non-portfolio foreign flows. Earnings growth of around 20% annually over the next 3 to 4 years, led by an emerging private capex cycle, re-leveraging of corporate balance sheet and unfolding of a structural rise in discretionary consumption and a reliable source of domestic risk capital.
All right, now let's move on and get you some money market views as well. Lakshman B of Federal Bank says US CPI inflation rose to a 3-month high of 3.4%, leading to strengthening in the dollar index. He says the US 10-year yield traded above 4% levels post the inflation print, and the 1-year USD INR annualized premium traded at a 3-month high, while the rupee yesterday traded at a 3-week high against the US dollar on the back of robust inflows. He expects the USD INR pair to trade in a range of 82.78 to 83.23 in the next few trading sessions.
All right, and on the bonds, Lakshmanan says domestic bond yields fell, aided by expectations of rate cuts by the US Federal Reserve. However, he says the US December CPI at 3.4% and robust economic data could potentially delay rate cuts by the US Fed. He says markets await inflation print for India, which is expected slightly higher, around 5.9%, due to elevated food prices against 5.55% in November. He says coming sessions could see the 10-year benchmark bond yield trade in a range of 7.15 to 7.25%. All right, let's take it straight to Robert Sorkin, the global economist at Citi, who joins us now to give us his view on all that's been happening across the globe. Robert, thanks a lot for joining in. All eyes will, of course, be on the US Fed rate cuts when they begin. But the focus has really shifted now to emerging markets like India, where, the foreign inflows have started to pick up significantly. As we kickstart the new year, what does your pecking order look like as an economist within emerging markets and in the developed versus emerging market piece?
Yeah, that's a great question. And thanks so much for having me. First, in terms of the just growth outlook, we do think growth is going to slow down globally in 2024. We had a much more resilient 2023 than we were expecting. That was largely due to upside surprises from services sectors. We had underestimated the amount of momentum post-COVID that we'd see in services around the world. But we think in 2024, that process is going to slow. Interest rate hikes are going to bite more, and the manufacturing sector is going to remain weak. But that being said, emerging markets are a relative bright spot in our forecast. Most of the slowdown in global growth that we have for this year is concentrated in developed markets. We think a range of developed markets are going to go into recession, including the US later this year. But EMs, while they slow down, are likely to hold up relatively well. Now, in terms of monetary policy, some EMs have already started easing rates. We think more are going to follow throughout the year. And those DM central banks are probably going to start easing around mid-year. We think the Fed's going to start cutting around July, the ECB slightly earlier, and most DM central banks around there. Several EMs will have already started easing before then. But as long as these DM policy rates remain elevated, it's going to be hard for EMs to ease policy very rapidly, given high global policy rates. So we do think EMs are better positioned, but in some sense, their monetary policy is somewhat glued to what developed market central banks do.
Hi, Robert. Good morning and good to see you in. Robert, last evening, the inflation print that came out was a little hotter than expected, though the fine print was pretty okay. Give and take everything, the kind of resilience you're seeing from the US economy, would you want to quantify what kind of rate cuts are you all factoring in?
Yeah, and this is the key question. And I'll say about today's print, something that worries me the most is if you look underneath the hood at services ex housing, that has shown very little progress over the last several months and looks to be stuck somewhere at just under a 4% annual pace. And it's why we think in order to really break that type of inflation, you're going to have to see a slowdown in growth and a loosening in the labor market to really bring down wage growth, which is getting passed into those those prices. But that process could happen. It's possible you could still get that services inflation to come down without a recession if the supply side, for example, in the labor market continues to improve. But either way, I think what today's print highlights is the Fed is unlikely to start cutting rates early this year, given that we're still seeing a lot of stickiness in the services side of the inflation equation. So we still have the first rate cut coming in July, and I think this print pushes down the probability that rate hikes start happening sooner. We'll learn a lot more at the January FOMC meeting when we see their tone around how they're thinking about policy throughout the year. But I think this print just shows that even if we do get a soft landing, it's going to be a slowed down move in inflation.
Okay, speaking of inflation, we're just getting those numbers out from China, by the way, and inflation is moderating. We put that on our ticker once again. Inflation at the consumer level, wholesale level, it continues to moderate in China. The export number is a little better than anticipated. Exports in December are up 2.3%, higher than the estimated forecasts out there. But the number for the year as a whole is a sobering decline of 4.6%. Imports are down, even exports are down for China. And that's the last question for this morning, Robert. China, 2023 was completely missing, dealing with its own macro woes. Do you see that changing? Because if China starts showing a recovery in 24, that has huge ramifications for inflation and, all of, these projections on interest rate cuts that we're talking about, right?
Yeah, absolutely. And China, I think, in particular, is getting hit not just from structural issues it's dealing with, like overhang of and restructuring in the property sector, but it's really getting hit hard by this manufacturing weakness that I mentioned and this global trade slowdown. So that engine of growth that China normally has not been there in this cycle. And so what you've seen is policymakers respond with stimulus to try and boost the economy. We think growth likely came in at about 5.3% in 2023 in China. We're looking for still decent growth in 2024, although a bit of a slowdown to 4.6%. Yeah. So I would describe that as a modest slowdown, but not terrible. But there's a lot of risks around that forecast, and it's going to require continued policy support from the authorities.
Got it. All right, Robert, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here. Have a good week. We'll slip into a good weekend, rather. We'll slip into a quick break on the other side. TCS will be in focus and many more stocks that we'll talk about. Stay tuned.
Welcome back. You're with us on Bazaar Morning Call. Well, let's straight away get to all the top stocks that we have to watch out for. And right on top of that list is, of course, TCS and Infosys. Rima, over to you. Take us through the TCS fine print first.
Thanks so much for that. So TCS has reported a beat on revenues and margins. So despite all the demand constraints, the company has delivered a top-line growth. The street expectations were for no growth. The company has a 1% constant currency revenue growth. And remember, this is the quarter when furloughs are typically higher. Their big sectors, core sectors like BFSI has been struggling, negative growth for the third or fourth consecutive quarter. So despite all that, the company has reported a growth this time. Margins too have expanded for the second consecutive quarter. In Q2, margins were up 110 basis points. They followed it up with a 70 basis points margin expansion to come in at 25%. In terms of the other key internals, the attrition for the company continues to tick lower, now at 13.3%. Headcount for the company has moderated. Deal wins are lower on a quarter-on-quarter basis. The number, the TCV, total contract value, is at $8.1 million, lower QOQ. But in a seasonally weak quarter, you would say it's in line with the long term, the last 4 or 6 quarter average. All in all, the investor community appears to be happy. The broad read-through from all the analysts that I've spoken to and the notes that I've read appears to be that the management sounds far more confident this time, and there is a sense that maybe BFSI is close to bottoming out, and that could be a big driver for the company, coupled with the fact that as their deals ramp up, FY25 growth will pick up.
Absolutely. And, you know, Bernstein put out a report where they said that given the kind of macro uncertainty that we're seeing, these numbers from TCS and margins at a 7-quarter high is not a bad thing at all. In fact, we have the management of TCS that's going to join Rima in just a short while from now. But before you head to that, Rima, what about Infi's numbers? How did they look?
Infi, it's weak, but not as bad as what the street was fearing. So the company has reported a revenue decline. Revenues have fallen by 1% on a quarter-on-quarter basis, but the consensus expectation was for a steeper fall of 1.5% to 2%. On margins have declined by 70 basis points to 20.5%. Courtesy the wage hike the company is given effective 1st of November. Other internals include deal wins. Deal wins have come in at $3.2 billion, but of that, more than 70% is net new. Attrition is at 12.9%. Headcount is moderated for the 4th consecutive quarter. The pressure pockets for Infosys continues to be North America, BFSI, communication and retail. So these are pockets where you have seen a revenue decline for the company. But again, the Infosys ADR was up 4.8% yesterday, giving a sense that the investors appear to believe that the worst may be behind for the technology cycle, and we are on a growth recovery path. Back to you.
Okay, all right. Thanks a lot for that, Rima. Well, let's hop across to Abhishek. He's joining to give us some news on Nykaa. Morning, Abhishek.
Morning, Nigel. So there would be a block as per sources. Lexidel International to sell their stake via block. So the block deal is of about 2.62 crores shares which has been launched. This forms about 0.9% of the total equity in the company. Total block deal value is about 490 crore rupees. The pricing could be, the floor price could be at a discount of about 3.5% to yesterday's closing price. The lock-in is for 45 days post this stake sale. Morgan Stanley and JP Morgan are the brokers to the deal. Back to you.
All right, Abhishek, thank you very much. We'll watch out for Nykaa. Let's go to Vivek for more details on Polycab. They did put out some sort of a press release, Vivek, but I don't think there was much that was said in it, right?
Well, absolutely. So what the company has basically done is they've gone ahead and reiterated what they informed the exchanges earlier. So the company yesterday gave a clarification to the exchanges. They've said, as on date, the company has not received any communication from the income tax department. The other thing that the company has said is that they say so far there is no material adverse impact on the financial position of the company. Now, along with that, yesterday, Small Cap World Fund sold close to 8.5 lakh shares, which is total, 0.5% of the total equity of the company. Now, yesterday's delivery volumes were at 35% on NSE. And along with that, one important thing to remember is that the stock has now entered the F&O ban. That means that you cannot take any fresh F&O positions in this particular stock today.
Got it. Thanks a lot for that. Here's a quick recap of our stocks. Stocks with positive news flow: TCS, Infosys, Nykaa, Concor, All Cargo, Tata Power, AG Infra, Bhansali Engineering and TARC, while Polycab is the only stock that could see some volatility today. But let's head straight to my colleagues Prashant and Rima, who are at the TCS headquarters with Samir Seksaria, the CFO at TCS, and Milind Lakkad, the Chief Human Resources Officer. Thanks, guys. Take over from here.
Well, thanks very much for that. So, yeah, we're sitting down with the top leadership team at TCS. The CFO and the head of HR are with us. Gentlemen, great to have both of you here. Before I start, I just want to offer our condolences for the passing of Feroz Bandriwala. I mean, I'm someone who's sort of interviewed him, in these premises long ago, 10 years, 12 years ago. I mean, great loss for the sector and, of course, a real thought leader as well. So, our condolences. I just want to start with the quarter. First, congratulations. It's been a good quarter. And you've beaten what the street was expecting, not by a lot, but 100 basis points, 200 basis points. But it's a beat nevertheless. Samir, I want to start with you. Is the outlook also turning up, is looking up a little bit more?
So if you look at during the quarter, the performance has been good, and that has been led by our regional markets. If you look at it from an outlook perspective, if I look at from a pipeline, that remains strong. Order book conversion is good, and the conversion to revenue is going well. The overall sentiments remain similar to what we have seen in the past couple of quarters. Yes, there is a lot of optimism given the action which happened about a month back, but that to translate into our order book and see the conversion happening in terms of client commitments will probably take a few more quarters for us to reflect and comment on, but we also remain optimistic.
So typically in the past cycles, what's the time lag before the sentiment and things on the ground change? Is it when we see the first, rate cut by the Federal Reserve and actual interest cost savings come through for your clients? Is that when the, budget spends go up, the discretionary purses open up? Should we assume that as a, inflection point of sorts?
I think for now we'll wait and watch. We'll watch it closely. Till that, we are staying close to our customers and ensuring that, that their priorities are looked into to maximize on our growth opportunities.
Margins have come in better as well. What's the driver there? What are the drivers?
So if you look at structurally, we have been focusing on disciplined execution, and 70 basis points of margin improvement is on back of 110 basis points improvement in the previous quarter. You were grilling me last time that will we exit the year at 25%.
Yeah.
We did it in Q3, and we hope our momentum continues out there.
So Q4 margins better than Q3 as things stand, given the momentum?
What we are happy with what we have delivered, and that's a good one. But we hope that the momentum continues.
Samir, is there pricing as a leverage to increase margins? Because on the cost side, you guys have done a lot, but on pricing, will that help going forward?
So as a long-term lever, pricing has to be one of the levers which should contribute to it. Right now, the pricing environment is stable, but if you look at it from a realization perspective, which is a outcome of not only pricing, but productivity, tool sets, the mix of portfolio, etc. also, that has been improving over the last 4-5 quarters.
Samir, one of the analysts' notes read, the margin expansion was a positive surprise given the BSNL deal ramp up. How would you respond to that? Because the expectation in the market is that BSNL margins are lower.
So absolutely, like we discussed last time, we look at our overall portfolio and we'd like to balance our portfolio. So if you look at the plus 70 basis points,
your margins down?
So if we look at the plus 70 basis points, we had 80 basis points of headwinds coming in from furloughs as well as higher third-party expenses.
Okay.
That accounts for part of it. But in spite of that, we have been able to drive the rigor in our operations and get a positive thing. Yes, it will definitely have any large deal in its cycle. As we had said, in a project life cycle, there would be ups and downs, and we'll look at managing our portfolio.
So the margin headwind, which you called out of 70-80 basis points due to furloughs and higher third-party expenses, that third-party expenses is basically the BSNL deal ramp up.
Yes.
So it's a bit of a catch-22, right? Because ex the BSNL business, revenues would have been flat. But ex the BSNL revenues, margins would have been higher. Is that the right way to look at it?
That's the right way to look at it.
But you're happy where you are in that sense?
That's how we have committed to it.
And the ramp up with this BSNL order will take place over what time frame from here?
So incrementally from what we have called out, nothing to add. We have been delivering on the overall order, which is to be delivered over the next 18 months to 24 months. And we are on track of it. So we are a system integrator. So as the sites gets delivered, the ramp up on the overall thing would happen.
Samir, you also said realization improved due to higher productivity, better utilization and use of tools. Can you talk about this use of tools?
It's using AI and other tool sets. Our set of product tools, which is or the tools like Cognix, Digitate, etc. In delivering our operations.
And what about Gen AI? Has it started contributing to increasing your productivity, which can aid margins, or not yet?
Gen AI, right now, it's in its initial form. We have been internally using it in quite a lot of our things. But as we have called out, most of them, from a customer perspective, is on POC phase,
no,
and
not
some
customer.
of it is.
I meant internally.
Internally,
has it started boosting your margins when you use it? Or
not significantly, but we have started using.
So maybe a couple of quarters down the line, that would be one of the levers you will talk about, or is not likely or possible?
Let's wait and see then.
Let's just talk about people as well, Milind. So headcount has again sort of gone down, and I think it's something you alluded to when we spoke at the end of the second quarter as well. What does that tell us? I mean, one of the persistent questions and back and forth after the last quarter results was, what does lower headcount mean? It means low business, low visibility. Is that the way to look at it? What would you say after the third quarter?
I would not link it like that. When you look at headcount, you should look at long term. longer term means, imagine we hired a whole bunch of people, very, very large number in FY22 and FY23. And we were basically leveraging all of this workforce over the last 3 quarters, and we continue to leverage that. Coupled with disciplined execution, what Samir said. If you bring these two things together, you will end up with negative headcount. The negative headcount is a resultant. It is a resultant of all of these things which we do. It is not something which we plan. It's a result of the things which we do. And if you look at our gross hiring in this quarter, it's still a big number. It is still a big number.
But is the impulse not to, I don't want to use the phrase not hire, is it coming from the finance function? Is it coming from the business side? I mean, where is the...
No, I think it is a call which we make together as a leadership team.
Right.
This is a call which we make based on various factors, based on what we have, based on what does the business outlook look like, based on what is that we can run more efficiently. All of these 3 things come together and we drive that together. It is not a function call, it is an overall leadership call.
It's always collective, not one function call.
And you said that you won't be surprised if the headcount continues to moderate at the same pace.
I did not say the same pace, but it may, if it is a negative headcount again, I will not be surprised.
And what's the outlook for FY25? I mean, if you can just broadly, without getting into numbers or anything, will we see something similar?
Prashant, as you know, that our campus hiring is our strategic bet for our business. That has been our, what we do as a core aspect of our business. That will continue. We are the ones who are in the campus right now. The campuses are buzzing, very excited, and all of that activity is happening for FY25 hiring already. So that will continue. How the numbers will stack up over the year, we'll see how it goes. With respect to business market hiring, that is like always, we always decide based on the quarterly demand, and tune it based on what we need at the time. So that strategy continues. So campus hiring is a strong element of our business, and that continues.
How many freshers have you hired in the first 9 months of FY24?
We don't give out that number. We don't give out that number. But I'll tell you, every quarter we are hiring big numbers. We are getting in big numbers.
For FY25, I have a number of 40,000 fresher hiring. Is that?
So that is the number which I have been giving every year for last 5 years. And that is the number which we stick to. That is the number which normally works for us. This year we are starting definitely the hiring. How that number and what that number will be, we'll know as we go along.
But for FY24 also, you would have hired close to about 40,000 freshers, you think? Or?
I would not give away that thing, but we actually have been hiring. Let me tell you one thing. We have onboarded everybody we offered.
Okay.
Or we will onboard in this quarter.
Okay. Is there a risk of talent grab by GCCs, which are mushrooming at a fast pace?
GCCs have been there for many years, and it is something which our model is different. We basically have a lot of investment in training our people and bring them up from the campuses, which is not true mostly with the GCCs. So it's a very different model.
This is a question which is not related to numbers, but it's often brought about. Why is it that fresher salaries for engineers, why is it not gone up in the last so many years? It's still between the 3-4 lakh range.
It is. If you look at it this way, we actually are paying based on the talent, and we actually encourage people to basically come at different cadres of talent coming in, right? Whether we are starting hiring at whatever number we have doubled that salary for digitals. We have almost very close to the 10 lakhs for innovators. We are hiring people from NITs and IITs. We pay lot more.
So what's the starting salary now for freshers?
It has been there, the same salary what we've been giving for so many years. So I think the point is not that. The point is we are actually, even when they join, after they join, we tell them that this is the path you take. You take this path, your salary will double.
One of the phrases which we were discussing after the last quarter commentary was a 15-day planning window. I mean, the visibility was, I'm paraphrasing here, but correct me if I'm putting it wrongly, that the client budgets, etc., don't mean very much because things are changing mid-quarter. So the visibility window is very short. Is that still the same, Samir, or has that changed? Has that become a little longer now?
No, increasingly, we are seeing clients going on rolling budgets rather than having a committed budget at the beginning of the year and staying to it. And given the market scenario also being dynamic, it's always prudent to be dynamic on your budgets also and commit to.
But that is because of the macro uncertainty. It's not something which is changing per se. I mean, it is because.
I think it is a combination of both. The macro uncertainties also force you to do it, and the way technology changes, business priority changes. A combination of both of it is leading to the rolling budgets coming up.
I have a slightly off-tangential question. We all read economists and what they tell us what the economy will be in 2024, and we're at the start of the year. What is your own prognosis? I mean, you're in a better place than most to assess.
No, especially in the US. Rely on the economists.
Are you working is your base case that at some point the US will hit a soft patch?
I think we'll go by what the economists say. We'll not try to get into their job.
Okay.
All right, gentlemen, we'll leave the conversation here. Thank you very much for joining in.
Pleasure talking to you all.
Welcome back to Bazaar Morning Call. Hope you're having a good morning. Well, the focus is going to be on IT stocks to kickstart trade. Explains why the Gift Nifty suggesting we opened well in the green. Siddharth Kempa, the head retail research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Morning. What do you make of the Infosys and TCS numbers? Both of them appear better than street estimates. Between the two, which one do you like, and what do you make of the numbers?
Very good morning, Nigel. Good to be on your show. So if you look at the expectations from the IT sector for the quarter was not very strong as we headed into the quarter. This was, I think, the first quarter in almost last 26 quarters where we were expecting a decline on a Y-on-Y basis in the earnings. And to that extent, the street was a bit fearful about what could come out of the results. Thankfully, the results are better than expectations. Not that they have been out of the world, but the fact of the matter is that things are not that worse compared to what the street was expecting, and that is the soothing factor for the IT sector for now. If you look at the management commentaries, I don't think things have changed a lot to change the estimates or outlook. So both for TCS as well as Infosys, our estimates continue to remain same. Infosys has narrowed down the guidance, but the center point for the guidance, both for the growth as well as for the margins, continues to remain same.
Okay, and TCS saying that... Sure, go ahead.
Yeah. But if you look at in terms of what they have managed to do is that, especially TCS, they have managed to internally control costs and report a better margins, which has been a big factor for being more positive or constructive on TCS between the two.
Okay, got it. Just before we head to the rest of the team at TCS that's coming up in just a while from now, very quickly, Siddharth, what would you do with a stock like Polycab after the so-called clarification that came from the management?
Yeah, Sonia, so if it's a very difficult call. We don't have a coverage, but if you look at the situation, if a fund manager or investor is holding it and you are coming up with this kind of news, it's very difficult to take a call because the stock reacts negatively sharply. The company has come out with clarifications on both the days, but that will not help give any assurance to investors right now. So I think it's very difficult to take a call given the uncertainty or there is lack of clarity in the near term. Definitely, it's a red flag, and one should be taking a cautious view till things kind of emerge clearly. And till the time, I would not get into, if I were not an investor, I would not look at the correction as an opportunity.
Okay, all right. So that Thursday on, we'll have more questions for you. But right now, let's head back to the TCS headquarters for the next round. Reema and Prashant in conversation with K. Krithivasan, CEO of the company, as well as N. Ganpati Subramaniam, Chief Operating Officer. Back to you guys.
All right, thanks very much, guys. So we have the top leadership team at TCS sitting down with us. Gentlemen, good morning. Great to have both of you. And I want to start the conversation by just offering our deepest condolences for the passing of Mr. Firoz Vanzriwala, somebody who we all looked up to. I've had the pleasure to interact with, over the years earlier. So it was a great loss. Condolences.
Thank you.
It's been a good quarter, just to come to the business at hand. And you've beaten revenue expectations, you've beaten margin expectations, and suddenly there is this spark of enthusiasm. At least, I'm not sure how you guys are feeling, but all of us are feeling good. Are things looking up, or is just, sort of inter-quarterly kind of things which have made slight difference? Because they're not big beats, they're about 100 basis points, 200 basis point beats. Yeah.
Prashant, we are overall optimistic. We've been seeing the total order book wins, and we also seen many of them converting into revenue. So overall, we are optimistic. We are not. I think it's too early to call that things will be back to normal or back to good old days. But overall, we are optimistic.
Krithi, last time you spoke about there are leakages in your existing business. So while you are winning fresh deals, the reason why revenue was not growing is because leakages in your existing business, because when projects came to an end, they weren't renewed, discretionary spending itself is down. What's happening on this leakages front? Is it lower compared to what we've seen 3 months ago?
It's more or less same, Reema. It hasn't changed much. It hasn't changed much. But what's probably helping us is that we are putting more at the top than as the leakages remain same, we are putting more at the top.
When do you think leakages could, trough out and start going?
It's more a question of clients having confidence that these programs are going to return some other ROI on these programs, or the demand on ROI comes down, or they are confident about the overall economic situation, number of factors, but I think it's a overall economic sentiment that would change.
This economic sentiment business in the US, we've been waiting for a recession in the US for a year and a half now, right? And the data suggests, last night's data, for example, suggests that things are just, they may not be great, but they're okay. They're not, so this wait is what is causing all the trouble, not the actual thing.
Absolutely.
Yeah. I think, if you take India, we are used to our inflation being higher than the growth rate. And successfully year on year, we have always managed it. And actually, because how the inflation is driven differently in India compared to what is probably there. But in the US market, if the inflation is actually higher than their growth rate, then, people really watch out and then get into cautious mode, look at sentiments, look at what the consumer sentiments are, what the enterprises sentiments are, where the business volumes grow, how the stock market is performing. Many of these things play out, right? The way we see it is that in our client portfolio, it's kind of moderated, right? There are clients who are spending. There are clients who have gone with the cloud migration, cloud transformation kind of projects, which they are not holding. They say, look, keep doing. To answer your question in a different way is that the projects that got initiated 2 years or 3 years before, at that time, Gen AI was not there. Okay. So I think some of the holding back is to step back and see whether we need to tweak the architecture and then come back to it. So they are kind of stepping back, but it's not, does not mean that it is backing down.
Your cohort of customers, are they operating with the base case that we will get a recession in the US in 24?
I don't think they are talking about recession, but they are more worried about the inflationary trend. Second is that in an election year, they want to see some definitive trends, right? In terms of who is going to be the candidate, right? And where the wind is.
We know the candidates.
Where the wind is
blowing. Cautious than who are expecting a recession. They just want to be cautious.
That's interesting, though. Are you saying that one or the other would make a difference? in terms of how...
I mean, I think from a policy perspective, I think it will become clear, right, whether it is Democrats or whether it is Republicans and where, they will have their priorities. That indication will come through, right? So
then too early to talk about, so with the start of the year, one of the things we always talk about is client budgets, etc. So too early for that, or, I mean...
No, I think we always stated that, look, budgets are there. It's not that budgets are not there. And then, most corporations with whom we have worked on, they all said that, look, we have not heard anything like a budget cut or anything. But the way that they want to spend, the discretionary part of it is where, they're saying that, look, let's take a quarterly approach to it. Let's be agile about spending and see what, because if you take generative AI, artificial intelligence kind of thing, there are startups, there are products and solutions are coming every week. Something new is happening every week. So they want to see how those solutions are relevant to their business, what use cases will deliver the big bang for the buck that they are going to be spending. And all of that is making them say that, look, I'm going to be looking at a quarterly budget horizon. I'm not going to commit to you on a long-term budget.
That's better than 15 days, right? Yeah. Move to a quarter. Just joking, but...
No, absolutely right. Absolutely right. Yeah.
Gentlemen, I'd like your view on BFS, right? That's over 30% of your revenues.
Right.
Has BFS bottomed out? And I'd like both of you to answer. And
yeah, we see, like we explained yesterday also,
yes.
like there are two major headwinds for us in BFSI last quarter. There are some large programs coming to an end and seasonal furloughs. And if you would, going forward in Q4, we don't expect, at least the furlough will not be there. So that would provide a tailwind for Q4. I would like to believe that probably like it's bottomed out, but a quarter or two will tell us. But signs are positive.
Okay. NGS? BFS, the worst is over. Q&Q growth from here on?
I think we will see growth in Q4. Okay. And the deal wins that we have had this quarter is very broad-based, and BFS also contributed to those deal wins. And overall, I think I would say positive rather than, negative.
You also said yesterday in the press conferences that we could see furloughs in Q4. Is that normal or?
It's normal.
That's normal.
Basically, it's 3 weeks of furloughs in the Q3. And about a week to 10 days in Q4 is what the norm.
Okay.
And we are not seeing anything different than usually that we experience.
Sure. Kriti, one of the things in the call, I think what many have pointed to is pent-up demand, is the phrase that you use. What does that mean? Is there actually pent up and it will come out of the gates when this macro uncertainty clears?
Yeah, see, because as much as enterprises are spending on technology, we believe that all of them have a lot of technology debt. Okay, and they have to address the technology debt going forward. And they're not spending because of the market sentiments we spoke so much about. So once that clears up, this pent-up demand has to come back and it has to be addressed. And we are very sure that that will also drive growth going forward.
NGS, can you talk about the deal wins? Why is it that the industry itself has not seen mega deals this quarter? And you also spoke about the qualified pipeline being higher. Talk a little bit more about that.
Yeah. See, deals of large size, right, what we call as mega deals, takes its own cycle, right? Generally, they take about 12 to 18 months or sometimes even 24 months to mature, right? And we've got to have them in the right pipeline. So I don't see lack of opportunities. There are deals that we are, let's say, shaping, we are qualifying, and then I think they should come, in the coming quarters, right? The way that, I will put it is that 8.1 billion of deals this quarter comes on the back of 3 quarters of 10 billion, right? So we are happy with what we have got in this quarter, and it's very, very broad-based and deal sizes of small to medium size, which means that we will be executing all of these deals in, let's say, 12 to 24 or 36 months, right? Which is actually good for us to see the growth, what can happen to the growth of FY25 and so on. The other way to look at it is that, look, while we are talking about banking, financial services and so on, all the industries, one of the big players in terms of deal values and is the big tech companies, right? Big tech companies, if they don't come out and then say that, look, I'm going to be putting this, I'm putting that, then, that will also have an impact on the overall deal value. And I hope that, the big tech companies also come back to the parties pretty soon. Right?
But, the news flow which we're getting over the last couple of days in terms of fresh layoffs or from the big tech companies, some of the big tech companies, is not particularly heartening. Would you agree, NGS?
I would think so, but I think the other way to look at it is that they are the ones who are also embracing Gen AI probably faster than any of them, and they see the potential of Gen AI. Because all the others we are seeing the use cases and see how do we exploit the technology into this, right? And the big tech companies, if you really look at it, whether it's Microsoft or others, they're all looking at Gen AI as a big source of productivity and efficiency gain for them, right? And delivering some of those products into the field is going to be the critical thing. So they are focusing on that, right? So in that sense that they are employing the Gen AI for their own internal productivity, internal deliveries, to show to the other industries saying that, look, this is really for real, this is going to work for you, right? On the other hand, the industry verticals have to see how we can exploit the technology for a particular use case or particular business area, and whether it is sustainable, whether it will have regulatory issues, and so on, because the tech companies don't worry so much about regulation and compliance aspects, whereas each vertical, as they employ these technologies, we need to worry about the risks, we need to worry about the fact that it is responsibly being used and be compliant with all the regulations that are there. World over, every government is looking at saying that, look, how am I going to regulate this artificial intelligence? So that jury is not out there on that for many markets. So let's see how this pan out, but internally, we are also looking at Gen AI in a big way. We have done a lot of pilots, we've done internal projects, and we are quite excited about the possibilities that it can create for ourselves and for our clients.
Kriti, if BFSI grows in Q4, which is the base case assumption for now, will North America also grow?
It should, because we are doing well in manufacturing, we are doing well in energy resources. Life sciences has been doing well. If we are able to turn around BFSI, we should have a good turnaround. Because
North America has clocked negative growth, I think, for 4 quarters in a row now.
That's right.
Okay. Yeah. And what's the outlook on the other 2 verticals which have been under pressure? Retail, this quarter was a bit sluggish, and communications.
Retail probably should turn positive in near term.
Near term. Near term is 1 to 2 quarters?
May not be in Q4, but soon.
Okay.
I think communication will have more structural issues. It will take more time to turn around.
And the growth in manufacturing will continue, you think?
See, growth in manufacturing should continue for us because we are having both industry itself is reinventing, and we are also having very impressive market share gains in manufacturing.
Okay, one quick question on Gen AI. In Q2, you had 250 Gen AI projects that you all were working with. I think 4 of, and they were all sub $1 million in size. What's the number as of Q3? Are they moving, higher in value?
Yeah, they're all, being converted from pilots to actually moving into production, as we say. And then there is a steady pipeline, of such deals, right? But most customers are testing it.
But they're sub 1 million still.
Yeah, they're sub 1 million, they're piloting it, and then the whole question is, how do we get the architecture right? How do we make sure that whatever we come up with doesn't spoil the party, right? And make sure that it's nicely embraced internally as well as by their customers, right? And there are many projects that we are doing, including, for example, in the area of wealth management and advisory, client advisory. How do we, take Gen AI into advantage? So many such things are there. It will consolidate itself. I would say that over the next 3 quarters, in my opinion, this technology should mature and deliver some real good value for the industry as such.
Got it. Just one last question. Sure. F525, right, is what everyone is focused on. Now as compared to the end of the second quarter, how many more degrees optimistic or lesser optimistic are both of you? I mean, if I can...
I don't want to put a degree.
Or are you the same?
We are optimistic, definitely.
Okay. 5% more, 10% more optimistic? It's an unfair question, but
I would say reasonably optimistic.
reasonably optimistic. And yes,
FY25 will be better than FY24.
better than 24.
Okay.
I think we'll leave it there, gentlemen. Great to have both of you with us here on CNBC TV18. I wish you all the luck for 2024 and FY25. Thanks very much.
Thanks,
Thank
Prashant.
you.
Thanks
Thank
very much.
you.
Co-powered by sensex.
Okay, I think the big headline from TCS was that FY25 will be better than FY24, although there was a little bit of caution in their voice. Kush Bora joins in now to tell us about his views on the market as well as individual stocks. Kush, how are you feeling? Looks like it's going to be a good opening today. What are the stocks you're looking at?
Hi, Sonia. First, a very good morning to you and all the viewers. Well, I think if we were to speak about how one would look at Jan move so far, I think it'll be a whole lot of optimism, isn't it? We're almost halfway through the month and the dent hasn't been so deep. So I'm taking it, with both arms open. So far, the theme seems to be play the range. 21,450 on the downside and 21,750 on the upside has been the range. We're closer to the upper band, so I would wait for some dip on the indices for a fresh buying. So as I said, the 21,450, 21,750 range is what I will play for. Bank Nifty, incidentally, is starting to show green shoots. So I'll be a little more optimistic on that. 4,700 is the level that we're looking at on the upside in the near term. 46,900 is the level on the downside. As far as stocks go, two picks. NBCC, the stock has shown strength. There was a big breakout day before yesterday. Yesterday, there was a consolidation. I think 95 and 98 are, very reasonable targets on this one. 90 is where I would place my stop loss. The other stock that did very well was Power Mech. 49.50 and 5,100 are the next levels that we're looking at on the upside, and 4,600 to 4,650 is a support zone. So that should act as a stop loss.
Okay, all right, Kush. Good to hear your thoughts and good to see you. And well, Mitesh, good morning. Let's come across to you. How would you approach the index?
Good morning, Nigel. So we've maintained a range scenario. I think that still continues. We don't have a signal of a breakout or a breakdown. So 21,500 on the downside broadly, give and take 20 points, and on the upside, 21,800, 820 is the zone which I think the markets will trade in for the next few more sessions. And for the Bank Nifty, it would be about 47,100 to about 47,050 as the first support area, and then 48,400, 500 on the upside is the near-term range. So it's still a process of consolidation. The markets are making a base at new high, which to me is a positive sign. I think unless until we break the lower end, good chance that post this consolidation, we'll start making or getting into new uptrend again.
And individual stocks?
So I have all buy calls today. Ipca Labs is a buy with a stop at 1124 for targets of around 1,200. AB Capital is a buy with a stop at 176 for targets of 190. A buy on Aarti Industries, which in the last couple of days has given a pullback. Buy here with a stop at 612 for a first target of 640. And Dixon Tech is the final buy call. Keep a stop at 6420. Look for targets in excess of 6,600.
Okay, thanks a lot for that. Well, Siddharth Khemka of Motilal Oswal Financial is still with us. Siddharth, the IT stocks now are in pre-opening are looking very good. Infosys, in fact, is up 3.5%. TCS, the management commentary was a bit cautious, but they did say that FY25 will be better than FY24. Post listening into their commentary, what would your thoughts be?
This is in line with what we are expecting. So there is a gradual recovery. Margins have come off to the second consecutive quarter of margin improvement. And as I said, between the two, we believe that TCS, given its size, order book, and exposure to long duration orders and portfolios, is well positioned to withstand the current weak environment. So we are quite optimistic, at least from the growth outlook for FY25. However, as we said, the near term, we are not changing our estimates as of now, and we continue to maintain our numbers. So I think 1 or 2 more quarters of pain in the system is there, especially given that the macro outlook has not changed.
Okay, that is IT, big IT earnings coming through, and a reasonably positive management commentary, you'd have to say, from TCS in the present circumstances. Siddharth, hi, good morning. Surabhi here. I just want to shift the conversation away to the other major pillar and pivot for the market, and that is what Reliance has been doing for the past 2 sessions, right? Your thoughts on what could be triggering the market's interest once again? Is it a build-up to earnings? Could be something more? And, what's your own call in the stock?
Yeah, Surabhi. So I think Reliance, in terms of results, there's not much of an expectation, especially because of what is happening with the overall oil and gas sector. The things are definitely improving. I think the two fronts where things have kind of improved for Reliance, A is on the geo front, both on the geo telecom as well as on the geo financials, where there is some improvement in numbers. Geo financials listing and value unlocking has definitely helped the company. And if you look at in terms of GRMs, Singapore GRMs on a Q&Q basis has definitely seen some improvement, although on a Y-on-Y basis it continues to remain lower. And again, I think it has been a long underperformance within the index. If you look at Reliance, which has been one of the highest weight counters, and with market at all-time highs, I think there is a lot of interest now in terms of valuations that the fund flows are moving towards Reliance rather than interest more towards the earnings.
Yeah, I just want to point out, by the way, that in the pre-open, thanks to, the fact that TCS and Infosys have been better than really bleak expectations, these two stocks are, notching good gains in the pre-open. The Nifty is, as we were saying earlier, is probably going to test the upper end of the range. And for that, we need to watch out for, the previous level. So 21,760, 750 thereabouts. These are the previous highs. And then, of course, we go on to talking 21,800 plus. But right now, I think a test of the top end of that band in all likelihood is possible. And if Reliance plays ball along with the IT boys, we know what that means.
Also, must point out that the TCS management was not very encouraging, to be honest. It's just that there was no negative surprise this time, both in Infosys numbers and in TCS also, given the kind of macro environment that we've seen. These are not a bad set of numbers. But having said that, one must keep in mind that, it's not all hunky-dory in the IT space. They're still very cautious on several pieces. So I think it's just positioning of the market, right? Going into the numbers, they had some optimistic views. All right, Sudarshan is joining in now. There are some brokerage notes. So in case you're wondering what brokerages are saying about the IT space, Sudarshan, over to you.
On brokerage radar, today we have first CLSA, an oil and gas company. CLSA says it's a tight crude market, but refining and LNG appear oversupplied. CLSA is downgraded Petronet to underperform from buy. Target is rupees 240 per share. It downgraded GSPL to outperform from buy. Target is rupees 360 per share. It has a buy on ONGC. Target is raised to 240. It has a buy on Oil India. Target is raised to 435. Among city gas companies for CLSA, IGL and MGL are top bets. Also, recently it had downgraded HPCL, BPCL and IOC to sell and downgraded GAIL to underperform. Next is CLSA on HDFC AMC. It has an underperform rating. Target is raised to 3,440 per share. CLSA says AUM growth of 26% year-on-year was strong, with equity and ETFs delivering growth in the range of 46 to 54%. Also, despite market share gains in equity segment, yield saw some compression. Next is HSBC on HDFC AMC. It has a hold rating. Target is raised to 3,410 per share. It says healthy operating performance in Q3 and was supported by market share gains and strong industry tailwinds. It believes EPS growth is likely to be slower than AUM growth, and HSBC expects EPS CAGR of 9% and average ROE of 28% over FY 25-26. Last is Goldman Sachs on Zomato. It has a buy rating and target is raised to 160 from 130 per share. It raises FY 24 to 30 net income estimate by up to 6%. Also forecasts 30% FY 24-27 adjusted revenue CAGR. Thanks a lot for that, Sudarshan. Well, Siddharth, I wanted to ask you whether you had a look at these smaller companies. You have HG Infra, that's won a big order. Couple of these other infra names as well, Bajal projects, not spoken about that, but they won a project coming in from Tata Projects. Any view on either of these two companies or some pick from the infrastructure sector itself?
Yeah, Nigel. So I think if you look at the overall earnings expectations, some of these the core infrastructure or core industrial sectors that have started reporting strong numbers. So including some of the likes of cement, capital goods, where we are expecting strong numbers overall. From this space, while we don't have coverage on these names, if you look at the broader space of the capital goods, we like Kirloskar Oil Engines, which is a strong player in the power gen segment, and they are expanding its footprint in the aftermarket as well as the exports market. Interestingly, the company is launching 37 diesel gensets in the new segment, which is the CB4 plus compliant products, which we believe will kind of not only give the higher yield, but also lead the next scope of growth. So overall, we are expecting a strong set of earnings growth driven by margin improvement, higher share from exports and aftermarket, and that should be leading to a 170 basis points improvement in margins. We like the stock from this mid and small cap name, Kirloskar Oil Engine, with a target price of 840.
I just want to point out also, keep an eye out on some of these platform companies like Zomato. Goldman Sachs has actually raised their target price on Zomato to 160 from 130. And it's the same theme, right? This online grocery and food delivery space that's expected to pick up quite a bit. Zomato is at a fresh 52-week high. Nykaa has also been picking up in the last many days, so do keep an eye out on that. And the other space to look at is some of these companies like HDFC AMC, where a lot of brokerages have raised their target price on HDFC AMC. Morgan Stanley has raised it to 3,000, HSBC has raised it to 3,400, so lots of stocks to look at. All Cargo Logistics is also in the news, so keep an eye out on that. So plenty of stocks to talk about. But I think as we head into... Yeah, go ahead.
Just in terms of stocks, I thought I'll just point out that the whole cable space, at least in the pre-open, there's some green. Now, whether that plays out in the actual market or not, but including Polycab and its, companions, KEI, RR Cable, for now, after yesterday's decimation, there's some green on the screen.
I think for Polycab at around 5,600 odd, you were getting it at around 35 times, at around close to around 4,000 odd, you're getting it close to around 26, 27 times odd. I'm talking about FY26 earnings. So maybe some part of a valuation play, though this corporate governance issue will continue to linger till the management comes out and clarifies what exactly has happened and what's the way from here on.
Absolutely. They need to come out and speak to their shareholders, but I guess it's a matter of time. For now, it's a very, very good opening for the market. 120 points in the green for the Nifty. The sensex is up over 400 points. Look at the IT stocks. Infosys is topping the charts this morning, 5% higher on Infi. TCS is up almost about 3% and it's taken the entire IT pack with it. Wipro, Tech Mahindra, LTI, Mindtree, HCL Tech are all up in the green. And as we know, Wipro and HCL Tech come out with their numbers today. Ahead of that, there is buying action definitely. The other space that's looking good this morning is the metal space. Tata Steel is up in the green a tad bit actually. Hindalco is also showing some green hues. JSW Steel is also trending upwards. So don't take your sight off that. On the downside though, you have some of the consumer stocks that are under a bit of pressure. HUL, Britannia, Nestle, Titan, ITC. All of these stocks are in the red. Nothing alarming, but just that, some bit of money being taken off the table over there. There's also some news on Nykaa. I think there's a trade that has happened on Nykaa, so just keep an eye out on that. We'll get more details in a bit. But for now, the market is quite good. Just coming off a tad bit, really. 90 points higher now on the Nifty. Advanced decline ratio is also pretty good as we speak. Let's just get Polycab up on the screen to see if that,
4% up straight away.
Okay, 4% higher. So Polycab, okay, now 1.5%. So people may still not be as convinced because they're waiting for the management to come out and clarify. But for now, that's going to be in focus definitely. A lot of stocks hitting fresh highs today. So Tata Power is at a fresh high. Zomato is at a fresh 52-week high. Tata Motors is at a fresh 52-week high. And then in the broader markets, plenty of stocks, but good opening.
Well, that's right, Sonia. Good opening, and if you want to play the macro call, you'll be looking at the large cap IT names. But if this, things are not as bad as were early feared, then maybe mid cap IT could do a little bit better. And it seems to be playing out. You have Mphasis that's higher. You have Birlasoft that's higher. Coforge is higher. In fact, some of these names, in the last few sessions itself have had a very, very good run. Birlasoft, the last 1 week is up close to around 7%. You have Persistent Systems as well as higher. So mid-cap IT is also doing pretty well. Let's focus on a few more names then that are moving higher in today's trading session. You had HG Infra. They were declared the lowest bidder for a project worth around 700 crores by the Central Railway. So that stock, in fact, has opened well in the green. Bajal Projects, they've got a letter of intent for projects worth around 488 crore rupees. So that one's opened up well in the green. Bansali Engineering, well, they've got an environmental nod from the Rajasthan government for capacity expansion. So that as well opened up with a gain of around 2.5%. And TAK, they've launched a residential project in New Delhi. Potential, they say, in terms of revenues is around 4,000 crores. So that explains why that stock as well is higher. All Cargo for December, they say CFS volumes are up close to around 9% on a year-on-year basis. The street likes that. It's up close to 13% on a month-on-month basis. And finally, Concor. Well, out there you have the total quarter 3 volumes that were up close to around 6%. So let's see how Concor has opened up. It's opened up more or less flattish, but a good start.
Absolutely a good start. I'll just add some more names. Macrotech started off quite positive as well. I think about 4% up last I checked. So it's been looking good. Largely, I mean, the market is fine. We just need to watch out for whether this bounce can continue and whether, there's enough ammunition to build on it. The problem area for the market right now is FMCG, and that's been a continued story from the previous couple of sessions as well. There's a lot of pressure, across the board pressure on the entire FMCG pack. And today, Reliance is not batting on the green side, at least for the timing. So let's just see how that goes. But let's take the conversation forward and discuss the outlook ahead for this market. We have Harsha Upadhyay, President and CIO at Kotak Mahindra Asset Management Company. Harsha, thank you so much for joining in. Season's greetings to you. Wish you a very happy new year as well. And, straight off the bat, let me ask you for your verdict on what we've seen and heard from the two IT big boys just yet. Given, what we've sort of seen since yesterday, do you at all get the glimmer of hope that we're at the bottom and it gets better from here? And what is your own positioning on IT and, taking that forward to the overall call on the market as well?
Good morning, Surabhi. We believe that probably we will see some growth acceleration over the next couple of quarters. It's too early to say that how strong it is going to be. But seems like the growth differential that we have seen between mid-cap IT names and the large-cap IT names seems to be coming down. And also we have seen very, very aggressive cost focus by the large-cap IT names by the result that we have seen until now, which also augurs well because the attrition rates are coming down, and if the continued cost focus allows them to look at higher margin trajectory with the possibly better growth momentum, then I think it augurs well for the large cap IT basket. And probably given the fact that the large cap IT names have kind of underperformed the mid cap IT names over the last year and a half, probably it's time for some catch up in the large cap IT names.
So you're overweight on the sector, as in are you looking to add more given that you're sounding quite confident and optimistic, Harsha?
We are still probably around neutral weight on IT sector at this point of time, and maybe in a couple of months we are underway. But over the next few quarters, we will keep looking at the growth trajectory and take a call. But our comfort is more on large cap IT names at these valuations as compared to mid cap IT names.
Okay, that's interesting. And the moot point here being valuations, right? After the kind of underperformance that we've seen, the kind of concerns in the last 1 year, IT valuations are now perhaps looking a bit attractive. Got it. They are the biggest gainers. There's good buying that's seen. In fact, Infosys is now up 5% on top of the gains that it's seen in the last 1 month. Harsha, thanks for joining in. The next big trigger will come in from the banking names, right? You have HDFC Bank's numbers next week on the 16th. What is your view on the private sector banks? How are you positioned here?
Again, this segment seems to be one where there is relative valuation comfort, even within the large caps, I would say. And as far as our view is concerned, large caps are at a better valuation as compared to mid and small caps overall. And within large caps, the banking names probably give you a little more comfort. And overall growth trajectory should be more or less as per expectations. So no great deviations from expectations in that sense. So overall, it should be a decent segment to continue focusing on.
All right. Hi, Harsha. Morning, and good to see you. And as always, Nigel on this side. Harsha, I wanted to ask you, what's your positioning on the auto space? You know, we have the numbers that just came out. Bajaj Auto, they are revving up the engine. You know, they're sounding very, very optimistic about the future. I think you have exposure to Maruti as well as Hero MotoCorp. At current reckoning, what is your preference from the auto space?
Nigel, we continue to remain positive on the auto segment overall. Within auto segment, probably the more comfort is on two-wheelers and passenger vehicles rather than tractors, which is seeing some bit of demand deceleration at this point of time. Also, given the fact that monsoon was deficient this time, there will be focus on next year's monsoon until we get more confidence in the tractor sales. So to that extent, probably in the pecking order, two-wheelers and passenger cars would be above our tractor segment in terms of the growth going ahead. And as far as the margins are concerned, I think more or less most of the companies in the auto segment should deliver decent margins. So overall, as we have seen in the past 2 quarters, as well as what our expectations are for 24, rest of 24 and financial year 25, we believe that auto segment will deliver earnings growth, which is going to be higher than that of overall market. So to that extent, this will continuously be one of the focus segments within our portfolio.
Okay. Harsha, what's the sense overall on the market? Because we've started this year with a bit of ranging action, a lot of moving parts. I mean, there's, the general election, the vote on account is coming up, and there's just a lot going on. And then we need more clarity on the pace of US rate cuts as well. I mean, if you put on your, magician's hat and try and look ahead in the future, what's the overall sense that you have? Is it going to be more of a range-bound year, or can we actually expect the bumper rally of 23 to continue?
So clearly, what we have seen over the last year or last years, I don't think one should take that as a base case assumption for the next 1 year or next 3 years. One should definitely have moderated expectations from equity. They will definitely do better than many other asset classes, but I think probably with higher volatility than what we have seen in the past couple of years. As long as the earnings growth is continuing to be strong, I think there is going to be enough returns coming from equity markets. We are expecting about mid-teens kind of earnings growth for the Nifty basket and a higher amount of growth for mid and small caps at this point of time. So from a fundamental perspective, there seems to be very little in terms of negatives at this point of time, whether you look at economic backdrop or corporate fundamentals. However, valuations have moved up and continuously have been moving up. So to that extent, one needs to keep an eye on valuation, because if there is any external headwind or any pullback in the markets for whatever reason, then I think the valuations will come into play and can lead to more volatility than what we have seen in the past couple of quarters. So that's something that investors should be open to embrace.
Okay, just want to point out momentum is really picking up in the broader markets. Don't be fooled by the headline index, which is flat now. But just look at names. Polycab is now up almost 3%. Trent is gaining quite a bit of ground actually for the last many days. It's come back into action. Trent is up about 2% or so. Macrotech Developers is up 2.5%, and real estate has been very, very strong. And now the entire mid-cap IT space is also coming alive. So whether it's Cyient, Mastech, a couple of others looking pretty good. But just before we let you go, all right, in fact, I think we've run out of time. So Harsha, thanks a lot for joining in. We will take this discussion to another day. But since you're mentioning, the IT stocks, they're all up and about in trade. Just wanted to mention that. Let's move on to another market conversation now. Rupal Agarwal, Senior Research Analyst, Asia Quantitative Strategy at Bernstein, joins us now to give us her view on how things are shaping up. Rupal, thanks a lot for joining in. Appreciate your time here on CNBC TV18. I was at the Vibrant Gujarat Summit for the last few days, and I got a very positive sentiment on the Indian markets, specifically from a lot of foreign investors, saying that the growth in India is unlike what we're seeing with our peers. Not just that, but the demography, right? How young our demography is. That's really helping in terms of consumption picking up in a big way. How are you feeling about India now, and what are the big trends that you're noticing in 2024?
Thank you so much for having me. So I think for this year, we're actually starting with a slightly more moderate view on India. A lot of these things that you just spoke about is not new, right? These are in fact some of the reasons that we've seen this massive foreign inflow last year. And in fact, if you look at the total institutional flow that India got, it was the highest ever from 2007. So I think a lot of that is in the prices to a large extent. And hence, the way that we're looking at the market this year, it's going to be a moderate year. A lot of the support that was there for the market is essentially, fading away. It's not negative, but it's fading away. Whether you look at earnings upgrades, whether you look at flow, whether you look at this big disconnect that the valuations are right now having with the bond yields. So I think the rate cut wagers, in my view, has gone a little too ahead of its time, and that needs to be recalibrated.
Okay, all right. Hi, Rupal. Good morning and good to see you in. Rupal, what's the view, though, globally? Chinese economy continues to struggle, and India has obviously been benefiting because the +1 trade has been working out. But everything's good at a price, right? Do you expect more money to start flowing towards China rather than India?
We are expecting a China rebound this year. Whether that's already playing out in terms of investor money flow, Not necessarily. We've definitely seen a bottoming out of outflows from China, which was actually extreme last year. So there are things which are at inflection point, I would say. And based on some of the recent conversations that we've had, some of the global investors have been trimming down their extremely overweight position in India, slightly adding to China. But we've not come across yet too many investors who would be looking at an underweight India. So I think that's where we are heading.
Interesting you mentioned that, Rupal. So I guess what you're suggesting is that a bit of a lighten up on India, get back into China trade, that perhaps could start. But, let me try and play the devil's advocate here. A lot of people on the fundamental side argue that that earnings are still coming in, and then, we're expecting a pretty market favorable election result, if I could call it that. Any downside risks to your view, the call of a moderate year on India? What could be the caveats here?
I think the caveat here is essentially that there is, of course, a very strong momentum in the market. In general, the investor sentiment is positive. So everything that I just spoke about in terms of earnings upgrades are peaking, flow is peaking, it's not negative, right? So that's, of course, the downside. I think the other thing is, and we mentioned this in our report as well, that equity risk premium in India still remains very low. While we expect that to move higher, it's not yet bottomed out. So I think that still remains a key support for the market. And that's one of the reasons we are taking this approach that, okay, it's okay to actually chase momentum names. Some of the names that have done well last year could actually continue to do well this year as well. Especially if you are, getting into names at this point, I would still recommend to be more cautious around valuations. But at the same time, I think there is a need to add a little bit more quality names, back to the market or back to the portfolio, because what we saw last year was this massive junk rally that happened between March and December, and I don't think that's sustainable.
Okay, so when you say add a little more quality names, right, I'm sure you're talking about adding large caps to your portfolio, but what is the sectoral preference now? Because we're seeing some signs of revival in the IT space, although the managements are still quite cautious, might I add. But how are you positioned here in IT versus banks? What's your call?
Yeah, so I think tech features reasonably well in our buy recommendations. And I think one of the bigger reasons is that the earnings downgrades bottomed out for tech, and it's still in that recovery phase, which is actually quite, it's standing out for tech, because if you look at some of the other sectors, the upgrades have peaked. So, clearly the momentum is fading. So tech is fine for us. I think consumer discretionary is the other sector where we are able to find momentum names, reasonably quality names, which are also reasonably valued. So that's another sector that features prominently. Financials, again, selectively, we are okay with financials. Honestly, there are not too many opportunities that one can get into at these valuations. Of course, it depends on everybody's valuation thresholds. The way that we've looked at it is we've ignored everything which is trading above +1 standard deviation to that 10-year average. So that becomes our benchmark.
Tell us more about that call, and being selective on financials. What's the pecking order? Will it be the private banks over the PSUs? The PSUs have given you the big money, or will it be some part of that could be towards NBFCs as well?
Actually, largely private banks. I'm not in favor of, in general, the PSU trade, which, in our world will basically be a proxy of the value trade. Value in India has never been so crowded, has never been so expensive. It's actually a 25-year high in terms of valuations as a portfolio. So we are not very positive on, in general, chasing everything which is PSU names. There could still be, of course, longer term tailwinds, which will give us some momentum in these names in the short term. But I think we are still going to not chase too much of that.
Any other new thoughts in terms of sectors or themes for this year, Rupal? For instance, you're talking about value. I was just thinking of FMCG. The problem is it's neither value nor growth these days. So it's kind of somewhere in the middle and, therefore, a little unloved. But how would you look at that part of consumer or anything else that you're optimistic on for this year?
Yeah, so I think FMCG, again, we are not finding too many opportunities there. Last year, it was still, reasonably there in our portfolios. I think one of the bigger reasons, again, is valuations. And in fact, interestingly, consumer staples is one sector which is already, back into the earnings downgrades territory along with materials. So not very positive overall on the sector. Selectively, again, there could be few opportunities here and there, but in general, we're not very positive on staples.
Okay, just before we let you go, there is the vote on account that's coming up. And of course, ahead of the elections, there's no major expectation from this vote on account, but there'll be the big budget in July. And, trends look like the current government could sort of attain a third term. If that happens, then from an investor standpoint, from somebody who observes markets, what would your big expectation be this time around?
I think in terms of elections, I would say actually that was one of the big reasons why a lot of FIs came back very strongly. In fact, before the state election results, there was a lot of concerns that we were hearing from global investors because they were considering that, at the central election, there could be negative surprise. But the state election results, I think, sort of solidified, this sort of central results that we could expect. So not a lot of negative sentiment around that. Of course, that has been one of the bigger reasons why we are seeing a lot of the, the PSU names rally or, anything to do with China Plus One, the broader industrial theme. So I think a lot of that is basically running up because of the election positivity that everybody is now expecting. And that's one of the reasons we say that, it's just become too much of a crowded trade. We've never seen these kind of valuations. So one needs to just take a breather, right? There would be better entry points in some of these names. They're clearly longer term tailwinds. So we don't deny that. We are still very positive on Indian markets in general from a longer term perspective. I think one needs to be a lot more selective in the short term.
Okay, all right. Rupal, appreciate you stopping by and filling us in with your views on the Indian markets. Structurally positive, but maybe in the near term, a bit of a risk owing to valuations. For the time being, though, we'll slip into a short break. We'll come back. Mr. R.K. Goel, the MD of Kalyani Steel, will be joining in to discuss the acquisition that they did a couple of days ago. You stay with us.
Co-presented.
Well, Kalyani Steels, that's the stock on our radar. Remember, yesterday the stock was up more than 15%. They have been declared a successful bidder for the acquisition of assets of Kalyani Steel for a consideration of around 450 crore rupees. Mr. R.K. Goel, the MD of Kalyani Steel, joins us on the show. Well, Mr. Goel, first of all, good morning and congratulations. I think for the last 10 years or so, whenever you have joined, to ask you, Mr. Goel, what are you doing with this cash? Good to see finally you're utilizing this cash in your books. So give us that detail first up. What is the last recorded cash balance? And all of this, I guess, will be funded via the cash in the books itself. And what is the additional capex you need to incur for this unit that you have acquired?
Good morning. Thank you, Nigel. And thanks for your good memory that you remember, I think, almost all my interviews. That's really great. Finally, we could get a very good quality asset. It's the quality of asset which we have gone for. It is a melt shop. So all the other equipments we need to set up, we are working out. And we are largely thinking of producing green steel in this plant. And yes, the production we can start immediately, but then we need to have balancing equipments related to rolling and others, because this plant was set up to produce crude steel for manufacturing seamless tubes and other things. So now we are already working on it, and it will take some time by the time we are able to crystallize our thinking and go for expansion.
Okay, and the last updated cash balance was around 600 crores. Net cash is what we're talking about as of the last recorded number in your books.
You are absolutely right. In fact, you track our balances much better than what we do on daily basis. We had 600 crore free cash. Definitely, we can take out much more cash, which we have deployed in working capital and all, and various other places. So we can take out much more money from our books.
Okay, all right. And you said that this unit is already running. So if you could help us out with some financials, is it profitable? Is it making a EBITDA profit? And do you have to put in any more money, sir?
No, I'm sorry. This unit has hardly run in 13, 14 or around that time. Last 8, 9 years, it is totally closed. but it's an extremely good quality asset. We have to restart it, but it is just a melt shop. We have to restart with by setting up a rolling mill and all, which will take us some time. Meanwhile, we are working with some of our key customers in Europe and US, what they would like us in green steel specifically, and we'll be producing largely green steel. And as of now, this will be one of the largest investment by Kalyani in green steel, beside 250,000, which we are already producing in India in our Pune plant, the first green steel plant and the only one as of date, and producing the one of the lowest embedded CO2 in the steel in the world.
So what is the kind of money that you will be spending for this? How much capex are you going to be putting to work, sir?
It will be fairly large, but we are still in the process of restructuring about the size range and about the product specifications and all. But definitely, you know, typically a plant of this size will cost anything between 5,000 to 6,000 crores.
5,000 to 6,000 crores. All right, got it. I want to ask you a little bit more about demand, because, you know, auto demand has picked up in a big way, especially the premium end of the segment. Have you been able to revise any of your contracts? And can you just tell us what is the demand situation now? How much could it grow over the next couple of, next say 12 to 18 months?
You see, let's talk of 10 years for India. Nobody invests in steel for 12 to 18 months. The project will not be ready, will not be producing in 12 to 18 months. Now, as far as India is concerned, the type of opportunities available in India, it is tremendous, tremendous, and it is going to multiply. Look at the situation in Europe. I don't think steel manufacturing in Europe is viable. Steel manufacturing in US will also not be viable unless they keep on having some trade barriers in one way or other. As far as China is concerned, India has an edge over them, and people prefer to deal with us as compared to any other country, including China. So we are seeing a very large potential in Europe, US, and all the large automotive majors and industrial product manufacturers, industrial equipment manufacturers, whether it is in energy, oil and gas. So we'll be producing steel for very large portion of it for non-auto applications also. And that's where we see a very large growth for India. As far as the auto part is concerned, you know, auto industry is growing in India, particularly cars, passenger vehicles and all, and the growth will happen much more. The confidence of the people in the country, in the government has gone up after the results of last 5 states, and it is going to help the industry, the investment sentiment much better.
Okay, all right, Mr. Goel, you know, we get the green steel part, we get the big 10-year horizon, the political stability in India, but we want to know more about your company. So please help us out with that. The last recorded capacity is 2.5 lakh tons, as you said. Now you're adding this billet capacity, but as you said, it's only a melt shop. You'll have to add rolling as well over here. So say in the next 3-4 years, what does Kalyani Steel want to do? You had told us in the past you want to be a full-fledged steel plant. Is that plan still on the cards? Tell us what will your capacity be, say in the next 3 to 4 years, and what is the capex you'll have to incur?
You see, total capacity, if we run the melt shop the way it is, will be at least 0.36 million ton, incremental, right? But we are going to improve the productivity by debottlenecking and all. We are still working on that. So I'm sure it will be definitely much more than that. As far as the capex part is concerned, it is the total structuring of the plant, including the finishing facilities, component facilities, heat treatment facilities and all. We are working on it, but it definitely it will be in the range of 5,000 crore plus.
5,000 crores will be the total capex that you'll be incurring. Got it. And can we assume that by FY27, say, Kalyani Steel will be a 1 million ton steel plant? Is that a fair assumption? Because you'll be debottlenecking here. You already have 250,000.
I'm not, we are working on this time frame. 27, 28 is a good idea, but we are still working on it. Maybe we'll be able to prepone a little bit.
So 27, 28, you'll be at around 1 million tons?
Yes.
Got it. Okay, so that clears it out of the way. You know, a few days ago, we had Mr. Kalyani himself who was speaking to Shreen Ban, and they were talking about Bharat Forge's revenues going up to, to 20,000 crores odd. How much of your revenues comes in from group companies? And do you see this as a big opportunity? Because if Bharat Forge is going to be surging in terms of revenues, it could be more business for you.
Absolutely, you are right. Currently, we are supplying around 50% of our capacity to the group. And I'm sure more than that we will be doing in time to come, the way Bharat Forge is even growing.
Okay, all right. Since you're in silent period, we'll chat with you post your numbers. But final question, the auto contracts were revised upwards. That's what I understand from the industry. How much of a price increase did you get? Tell us the quantum and tell us the period as well. Is it a monthly? Is it a half yearly? Is it a quarterly?
We could get from some, but not all. With others, we are still negotiating. We are discussing with them. And it definitely starts from 1st of October.
Got it. I missed that, sir. What was the number? What is the quantum that you've got for those that have come on board?
Actually, it depends on the grade, but it is sizable.
Sizable, so quantify it. 1,000, 2,000, 3,000, 4,000. What is it?
You will force a number out of me. It is more than 3,000.
More than 3,000, and how much of, if I had to put a percentage to the total number of clients that you have?
It's difficult to say because it will depend on how much quantity we are able to supply to those vendors and all, but it is sizable.
Okay, all right. So we'll leave it at that. Thank you for joining us and answering all of those questions. Appreciate your time here. By the way, just wanted to take a look at the markets as well. The big space to be in right now, apart from IT, is real estate. Macrotech developers is now up almost 7%. There's huge traction that you're seeing over there. And now mid-cap IT is starting to come back in a big way. So we were telling you about how Sonata Software, Mastech, Coforge, Oracle, Happiest Mind, all up anywhere between 4 to 5%. So IT is clearly the space to be, after which there's real estate that's looking pretty good. Some spaces that are not looking that great, autos is giving back a little bit. So M&M is actually your biggest nifty loser right now, down 1.5%. Hero MotoCorp is down almost about 0.5%, and iShares as well is down almost about 0.5%. But otherwise, not a bad looking market at all.
Oh, yes, absolutely. We're seeing some of that traction continue, 21,741. So the Nifty is continuing to hold on to the bulk of its gains. But the thing is that the heavy lifting is IT, and only IT right now. Banks have to come out and support a little more. That piece is still a little confusing. And even the other large cap names like L&T, for instance, have been very, very flat, not getting enough contribution out there. However, let's now move on to our next segment. Speaking of banks, that is what we're focusing on. This is our special segment, Quarter Se Quarter Tak. And we are going to now bring you a curtain raiser on banking earnings. What lies in the third quarter? And more importantly, what is the outlook as we wrap up the fiscal? Abhishek is joining in with the key highlights and expectations. Abhishek.
Well, Q3 FY24 preview for banks, the December data from RBI as of 15 December suggests that the banking sector has seen a loan growth of about 20.15% year-on-year and about 5% quarter-on-quarter. This consists the HDFC Limited numbers as well. So low-cost deposit ratio has been declining for last few quarters, and one can expect the downward trend in CASA ratio to continue in Q3 FY24 as well for the banking sector. Hence, net interest margin will decline for many players as cost of funds will rise. So there can be operating profit growth rate slowdown as well, largely due to the decline in net interest margin and negligible trading gains in this quarter, which will actually impact the overall income side as well. One can see improvement in operating efficiency for many banks or many lenders, that is improvement in cost to income ratio in Q3 FY24. Now credit cost or NPA provision will remain on the lower side, thereby aiding the bottom line or the return ratios to remain on the healthier side. So banking sector is witnessing the best asset quality in over a decade, and it will continue to remain in a sweet spot. So you can expect the slippages to be on the lower side. However, also expect recovery and upgrades to be on the lower side as well. So write-offs will be a key spot to watch out for. The key highlight will be a deposit mobilization as it has lacked the loan growth, and what is the outlook on business momentum by various lenders that they gave out. We have key estimates from Kotak Securities. For SBI, they expect NII growth of 5.7% YOY and about 1.8% sequentially, and net profit to be a downward trend of about 0.1% YOY and about 0.9% sequentially. For Bank of Baroda, Kotak Securities estimates NII growth of just 2.2% YOY and about 2.1% quarter-on-quarter, and the profit growth to be about 3.5% YOY and a decline of 6.3% quarter-on-quarter. For SDFC Bank, we only have a sequential number because comparison is not favorable due to the merger of SDFC Limited. So NII growth is expected at about 6.8% quarter-on-quarter, while profit can decline by 1% on a sequential basis. For ICICI Bank, Kotak Securities estimates NII growth of 9.2% YOY and a decline of 1.8% quarter-on-quarter, and the profit growth to be about 15.7% YOY and a decline of 6.3% sequentially. And finally, for Axis Bank, Kotak Securities estimates NII growth of 8.7% YOY and about 1.1% quarter-on-quarter. They expect the profit of Axis Bank to be up about 6.1% YOY and about 5.9% quarter-on-quarter. Back to you.
Okay, thanks a lot, Abhishek, for that. We'll get you more commentary on what to expect from the banks. It's going to be an important one starting next week with HDFC Bank on the 16th. But in the meantime, the market is also looking pretty good. Mitesh Thakkar joins us now to tell us what we should be doing. Mitesh, the big moves are coming in the IT space right now with Infy and TCS as the biggest gainers on the Nifty. What's the approach now? Would you take profits here? Would you let your positions run?
Yeah, so I think, Sonia, we've been maintaining that in this range, we are now possibly heading towards the upper end of the range. So good chance that we'll head towards 21,800, 820. So if somebody wants to take profits, I think around 21,800 is when I would, start taking part profits at least and see if there is strength enough to get past 21,820. That could possibly be even better on the upside for the Nifty. So for the time being, stay long on the indices. If somebody has a trading position, I think good idea to trail the stop loss about 21,710 on the spot, or maybe 21,705.
Stocks, Mitesh?
Yeah. So I have a buy on Gas Authority. Keep a stop at 159. Look for targets of 171. And then Steel Authority, GAIL and SAIL. So SAIL is a buy with a stop at about 112 for targets of 122.
Mitesh, thank you very much. We'll come back to you during the course of the day. Let's see how it plays out. Right now, it is IT to the rescue. But for the time being, we're going back to banks. We just had that curtain raiser on Q3 expectations from Abhishek. And now we have a conversation going with Suresh Ganpati, banking analyst at Macquarie Capital. We also have Lata joining in to sort of, help us navigate through the heightened expectations. Suresh, let's get your broad thoughts in, at first. I think the quarterly updates for most of the banks were telling us that, loan growth is not really a problem for the system as a whole. But I think there's a lot of commentary and conversation about mobilizing deposits. What's your first sense on Q3, broad expectations?
Yeah, sure. So this quarter, there will be further margin compression across the board, because remember that last year, Q3 is when bulk of deposit rate hikes actually happened in a big way, right? So considering usually most of the deposits comes in the 12-month category, clearly you would see deposit costs further inching up in Q3 and margin should come down across the board. And there is definitely pressure on resource mobilization. And you can very clearly see that the constraint for loan growth is no longer demand. The constraint for loan growth is more coming from the supply side.
That point is taken. I mean, deposits is a big problem, but there are other problems on the loan side in terms of higher risk weights on unsecured and this AIF issue that Reserve Bank has gone after. So let me do one thing. Let me look at it company-wise. The first one up is HDFC Bank. We already know the deposit and loan growth numbers. What are your estimates, expectations, and advice?
Yeah, so it's going to be again another unfortunately tepid quarter, because what everybody was expecting here is that the ICRR impact, which was felt in 2Q, could get reversed. So while it will get reversed in 3Q, but still there is some upward deposit repricing. So margins will not necessarily pick up, maybe slight downward bias going into 3Q. And that clearly is going to be a disappointment, and market is not going to be happy about it, because for really the stock to do well in our view, and we do have HDFC Bank as a topic, we need to see margin improvement coming through and finally flowing through the core PPOP growth. So that's going to be a bit of a disappointment or a spoiler this particular quarter.
Just a temporary issue on HDFC Bank, this margin concern, do you see this as a passing phenomena? Or is there perhaps more to it than that?
Yeah, I know that you asked a pretty good question because it's been lower for quite some time. Look, I think the process of margin normalization is going to be a pretty slow, long process. So while, and there are pressures, as you know, on deposit mobilization across the board, and even more so, we have been talking about the fact that how CASA mobilization is becoming a big challenge, right? So the composition of deposits in general for the system itself is changing, and that is not any different for HDFC Bank, that you have to rely more on term deposits where you're paying higher. So in this environment, very clearly, you will continue to see margin improvement being a bit tepid. A lot actually will critically depend upon how well they can change the loan mix over the course of next 12 to 18 months. Note that they did grow their corporate portfolio pretty heavily during the COVID period when they couldn't do a lot of loans. They have to get back their mojo on retail in a very big way to actually see expansion in margins. Otherwise, the margin expansion is not going to happen.
Okay, what about the other banks now? You think ICICI turns in a very good performance, but you don't have it in your buy list?
No, it's the weakest PPOP growth quarter for them in, I don't know, 8 quarters or 12 quarters. I'll have to go back and see. So on the contrary, ICICI Bank will have a pretty weak PPOP growth. YOY numbers that we're talking about mainly because of the margin compression. Last year, 3Q margins were very high, and therefore you're going to see a YOY pretty sharp, if I'm not wrong, 30-35 basis point compression in margins, which will result in a pretty sharp PPOP issue. So this quarter, clearly from a margin standpoint, across the board for all banks, you'll see YOY numbers being bad, mainly because of the upward deposit repricing, and that's why I think core PPOP growth will be under pressure for all of them.
Okay. On ICICI Bank, just trying to play the devil's advocate here, last quarter was a very good quarter, right? And the narrative at that time was that, of course, it still is, that since Mr. Sandeep Bakshi has come along, he's not only improved the earnings quite a bit, he's also turned around a lot of the loss-making subsidiaries. Don't you think that could perhaps continue to provide the kind of premium that ICICI Bank is enjoying versus the other stocks?
No, so actually what has happened, Sonia, here is that ICICI Bank last entire year, 12 months, did very good in terms of overall performance across the board, right? And if you look at the actual core PPOP growth, the core PPOP growth was very good and consensus kept on upgrading earnings. But despite that, what exactly happened is that the stock was very flat. So in a way, HDFC Bank is capping the upside for the entire sector, I would say. The market is not willing to give a multiple higher than HDFC Bank unless and until people believe some of these banks can test the bad asset quality cycles. So despite strong performance, the sector valuation is getting capped because of HDFC Bank at this point in time.
Okay. And what about PSU banks? Would you still go after SBI, or now is the entire set no?
No, the entire set is no. We recently downgraded SBI from buy to a neutral, and Bank of Baroda, which we cover, from a neutral to an underperform rating. Now, the challenge that I see, Lata, here, and I'm not talking about for this particular quarter or so, they had record low level of provisions driven by pretty high corporate recoveries, right? So when was the last time you saw SBI provisioning levels being lower than that of private sector banks at sub 50 basis points? Right, so the point here is the corporate recoveries will not be as strong next year as what it was this year. Some normalization of credit costs is inevitable. Margins will also actually start coming down because of the falling rate cycle. So net, if you were to really include all of that, you are going to look at a downward pressure in ROA over the course of next 2 years. That itself will call for a derating or an underperformance of these public sector banks.
Okay. Well, there are some people on the street who are still very positive on Bank of Maharashtra and even the odd Central or IOB, simply because there is hardly any float in those companies, and perhaps they will have some more credit cost advantages flowing through. Your comment on that, and more importantly on NBFC, Suresh. You know, one was expecting that the money that will come from banks is going to fall because of the higher risk weight. But did you see the numbers that were announced by the Reserve Bank? the fall is only 1 percentage point. They were growing at 23%. I think now the last number was 22%. So, I mean, do they still have one good quarter, the NBFCs?
No. So, Lata, see, you have to understand, for example, BAF reported a pretty strong loan growth number, right? Because this quarter was the best festive season seen in the last, I don't know, the last 4 years or 5 years, right? So, if that indeed is going to be the case, that is there in the numbers. The RBI regulations came somewhere in
November,
between,
mid-November.
right? So, mid-November. By that time, the festive season had already gone through, right? So, so the numbers are yet to reflect, the RBI actions is yet to get reflected in the numbers. So, that start getting reflected with a lag. Now, what has happened here is that the banks, as a first step, have not gone ahead and raised rates. As a first step, they have gone ahead and tried to curtail credit supply to the NBFCs, because the biggest problem that RBI has with banks is bank credit growth towards NBFCs. That's been running at 30%. So the first step is to bring down that. Now, that's a slow calibration which they will have to do. That will happen over the course of next 6 months. So if you're looking at an FY25 number, I would presume the decline in loan growth for NBFCs is going to be far higher than what one anticipates. So in my opinion, easily we can see a 300-400 basis points reduction, depending upon what NBFC are looking at with respect to the loan growth numbers when you're looking at FY25, predominantly because of the supply-related constraints coming from the banking system. See, the NBFCs borrow 50% from banks, right, without any exception. And if banks are going to cut credit because of the Reserve Bank of India pressure, you're going to see a pull down of credit growth in them.
And what about margins?
No, one fintechs. Where are we on fintechs? Paytm, PB Fintech?
So it's a double whammy effect, right? Banks don't want to lend to NBFCs, and NBFCs cannot lend to the fintechs because of the fact that, you know, the credit risk has gone for the risk weights have gone up for them, and there is a greater issue with respect to the smaller ticket size segment. So the compounding effect on fintechs is going to be the highest, right?
Okay. We are unfortunately out of time. Suresh, will invite you again for perhaps insurance companies and when the big results come out. Thank you very much for joining us. So there you are. The start of the earnings season, bank earnings season from HDFC is not going to be gung-ho.
You know, it just reminds me of the time when, depositors had a choice. They could park money tax efficiently in debt mutual funds. That's taken away. Now you're going back to banks, and then therefore you have to, banks have to pay higher for all those FDs where we're going back and parking our money. So it's a double whammy, I guess.
Banks have to pay more for FDs because the Reserve Bank has tightened money supply in the banking system. And the government is not spending. The money is sitting with the government. So perhaps the worst is over in terms of deposit cost, but it's certainly not falling.
Okay, well, the market is something that's certainly not falling. Look at that, 100 points higher now. We'll take a quick break. On the other side of the break, we'll put focus on the commodity markets as well. Manisha Gupta will join in and some more stocks that are in the news. Stay tuned.
चलिए
Welcome to Bazaar Morning Call. Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at the crude oil prices because we've seen a very sharp surge come in for the Asian markets right now. It's trading 2.5% on the higher side for the crude oil prices. Well, it seems to be really easing off the kind of declines that we saw in the first 10 days of January, that is 2024. The surge comes in as the Red Sea has seen some escalation as far as concerns are on the concerns there. The US and Britain have said that they have carried airstrikes on Houthi-controlled areas of Yemen. Remember, it was yesterday that we were reporting that we have reports of Houthis launching almost 20 drones and multiple missiles on US ships in Red Sea. That was on 9th of Jan. So what US and UK have done is in retaliation to this, and that has added premium to the prices there. Also, when you look at the big names that have continued to keep away from Red Sea are just increasing in that list. You have Maersk, MSC, Hapag-Lloyd, CMA, BP also now saying that they are pausing all transit through Red Sea, and this could lead to, down the road, if this continues for too long, could lead to supply concerns coming in from that route. Remember, 12% of global trade happens via Red Sea, and there are some concerns as far as the freight prices are concerned or the supply itself that seems to be adding premium. Iran also, and this is a different news, by the way, that Iran has seized oil tanker with Iraqi oil. This is happening in Gulf of Oman. So there are various pain points now that are happening in case of Middle East, and this is the major producing countries that we have as far as crude oil is concerned, and we have seen prices gain up because of that too. In addition to that, now there is cold weather that has been predicted in US starting from 13 to 22nd of Jan. That tells you that the demand will take off for whether it's gasoline, heating oil and crude prices itself. The markets also are looking at concerns when it comes to data that we have seen come in from Europe, but the robust numbers that you've seen from trade in China has been on the positive side, and PPI inflation, while has seen deflation rather, but CPI has declined less than expected. So you have seen all China-related commodities and equities also do well, and that seems to be supporting crude. And it's not just crude. When you look at the natural gas prices, well, we've seen 5% of that gain in the overnight. The prices are trading at an 8-week highs. The kind of inventory withdrawal that we've seen has been much higher than what the street was anticipating. But even with that, we are still 11% higher in sense of a seasonal average. But the markets do believe that this week could be ending in the positive as far as oil and gas is concerned.
Okay, all right, Manisha, got that. Thank you very much. So oil and gas in focus. Let's now come back to equities and talk about some buzzing stocks. Vivek is tracking HG Infra for us. I think this is a company that's won an order. And Bhansali Engineering, where I think some sort of an environmental clearance has come through. Vivek, tell us more.
Well, absolutely right. HG Infra is the first stock that we're tracking. Stock is quite active in the session. So it's been declared as the L1 bidder or the lowest bidder. This is for a project that is worth over 716 crore. And this project has, the bid for this particular project was done by the Central Railway. So what does the company need to construct? Company needs to construct a new broad gauge line for the Central Railway, and this is what will fetch them the amount. The second stock is Bhansali Engineering. Some positive news flow over there as well. The company has received the environmental clearance from the state level environmental impact of Rajasthan. So now what the company can do is they can go ahead and increase their capacities. Remember, the company is present in both ABS resin. So now they can go ahead and increase the capacity over there or increase the production over there to close to 2 lakh ton per annum. And along with that, they also have received the nod for expansion of the saleable SAN, that particular resin too, up to 25,000 tons per annum. So on the back of that, both of these stocks quite active in the session.
Okay, thanks a lot for that. But the street is definitely either relieved or happy that there was no negative surprise in the IT earnings so far. Reema is here tracking TCS and Infosys. Reema, big movers there.
Oh, absolutely. TCS has reported a revenue margin beat. For in-fee revenues have declined on a quarter-on-quarter basis, but still much better than what the street was expecting, or not as bad as what the street was fearing. There are two key takeaways from the TCS management, which is a read-through for the entire industry. One, FY25 is going to be better than FY24. Analysts knew it, but it's always better when it's corroborated with the management. And also, when asked about the overall environment, the management said, Kriti, the CEO of TCS said, we feel reasonably optimistic going into FY25. The second one, and this is the big one, BFS returning to growth. If you know, more than 30% of the industry revenue comes in from BFS, and BFS is where we've seen the maximum pressure of the weak macros. If BFS is returning to growth for TCS in Q4, it's a big call and a big read-through for the entire industry. Also separately, if you note, in the last 1 year, it's more the mid-cap IT, it's the turnaround plays like your Wipro, HCL Tech, which have done very well. So the Nifty IT index has gone up 26% in the last 1 year, where Infy and TCS have lagged. Infy in particular, even with the up move today, is only up 7%. Now here's what brokerages have to say. Bernstein say the Infy management reiterated that its deal wins should start ramping up from the end of FY24, and they're forecasting a 10% revenue growth for next year. Jefferies has raised its EPS estimates by 2% to factor in the beat. While Kotak says that they've cut the Infy revenue estimate for next year to 6.6% from 9.1%, and for TCS too, they've cut the FY25 revenue growth to account for a cautious start to the budgeting cycle, while they are expecting a recovery to only take place in H2 of calendar year 24. But brokerages are more bullish, post these numbers, post the management commentary, and while the management may not have spelled out that things are recovering on the ground, they're still calling it status quo. I think the underlying message from the body language is that things are improving, and analysts too are reading the numbers with rose-tinted glasses, maybe.
All right, thanks a lot, Reema, for that. Let's slip into a quick break. On the other side, our special Indianomics segment, Lata will get chatting with a host of guests to discuss India's growth trajectory. Stay tuned.